You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin. His website, oilandgas-investments.com. Welcome to the show, Keith, and happy Canada Day.
Happy Canada Day, Jim. God bless you. Looking forward to our chat here.
Yes, I hope the fireworks don't cause any fire problems. Keep them over the water, folks. Keith, what's so bullish about Canadian natural gas right now?
Well, Jim, I'll tell you, absolutely nothing. I've been stunned here by what some of the valuations are that I'm seeing in the market. You know, we have a very simple natural gas thesis here in Canada. We are the farthest gas away from the U.S. markets, particularly the populated U.S. markets. So the U.S. East Coast, our own East Coast, Central Canada, Southern Ontario, we are the farthest gas in North America away from these big demand centers. So by definition, we have to pay the most transportation cost to get our gas there. So we have to be the low-cost producer to compete, and we're not. You know, you're looking at the Marcellus Formation in Pennsylvania that is like by far the lowest cost producer, right beside all these demand centers. And so we are just really being shut out of market after market. We're not selling really any gas into the Northeast anymore. We're soon going to be not selling much gas at all into Eastern Canada because, again, Marcellus gas is going to be coming up from Pennsylvania there. They're reversing pipelines that are now flowing from the Rockies to the East Coast, and they're reversing that so that all the cheap gas from the East Coast can go into the Rockies. And that means that gas, Jim, and this is all a big domino effect, all that gas now is going to get displace even more Canadian gas out of the U.S. Midwest and the Rockies. So we're really in a situation here where it's pretty bearish for Canadian natural gas until we get LNG actually flowing off the West Coast, and no one's expecting that for at least 4 years and possibly as much as 6 or 7. And yet, what we're seeing, Jim, is all the stock valuations are still pretty high, and companies are still willing to pay pretty big prices. Like we saw a deal here last week where a company called Lucrata was able to, symbol LXE, was able to sell a very small package of land to a big dog called Tourmaline, TOU on the TSX, for $80 million. And there's no doubt that the play right around those lands was pretty good, but still, that was just a crazy valuation for a very small bit of land, probably about 50% higher than what we've seen in the last 12 months. So I'm just kind of scratching my head here trying to think, why are people spending that much money on gas? Like, I know there's still some improvements being made in technology, and so that's lowering the break-even price for natural gas, but that's still a lot of money, Jim. There's no way these guys are really making any big profits on when they're paying that much for land. It's almost impossible.
Why would people be willing to pay so much money? Are they taking a look at a future where if we do start shipping to China and Japan, it's going to be pretty bright?
Well, yeah, I think there's a couple of reasons. One is that sometimes when you own most of a play and you want the last bit of a play, you're going to have to pay up for it. So I get that, and that could be part of the reason. And then the other thing is that, yeah, like LNG, if you can sell, if the LNG market comes back, and of course when we talk about this, LNG prices have been cut in half, same as oil, but, you know, people are looking out 20, 30, 40 years, right? So you're looking that you're going to have a couple cycles there, and right now we're in the low part of a cycle. So, you know, you got to believe that at some point in time, oil prices and LNG prices are linked to oil prices. Basically, LNG prices trade at about 13% of Brent. So you're going to see at some point in time the cycle peak back up again, and then all these guys are going to make a lot of money again. And I think that's what a lot of guys are thinking. Look, you got to think long term, and the time to buy this stuff is when everything's cheap. But again, like I said, the only problem, Jim, is it's not cheap yet.
Also, too, all those coal-fired U.S. power plants, and they have hundreds of them, are going to have to convert to natural gas so that they're much cleaner.
Yeah, we're seeing a lot of talk about that. I'm not as up to speed on that as maybe I could be, but certainly you're seeing retirement of coal plants. You're definitely seeing structural demand, long-term demand for natural gas in the United States increase at about 3 BCF a day. And 3 billion cubic feet a day is a lot, but even measured against the 75 billion cubic feet a day that the U.S. produces, that's still a lot. That's 5%. So when you've got structural demand going up by 5% a year, we need to have all this cheap natural gas around. And you got to believe that at some point in time, Jim, that balance could change. So maybe people are looking out to that. But right now, it's hard to see that in the near term.
Well, I think it was you who told me one of the things, though, with natural gas is that a natural gas field plays out a whole lot faster than oil, which can go on for decades.
That's right. Generally, that's true. So
if Pennsylvania's hot right now, 3 years from now, it might not be.
Oh, and there are lots of examples around, like the Fort Liard play here in Canada that was supposed to go on for decades and lasted 3 years and then petered out. That was a bit of a disaster, and those guys raised billions of dollars, hundreds of millions of dollars to get that play going, only to see it kind of disappear within 5 years. So you never really know. But certainly right now it does look like the Marcellus is going to be around for a long time.
We'll have more with Keith Schaefer right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Keith Schaefer. Well, the old song, Farewell to Nova Scotia, can be changed to Hello to Nova Scotia when it comes to oil exploration and new discoveries.
Yeah, Jim, we're really seeing some interest here by some big companies, and of course, anytime you're talking about offshore exploration, it's got to be the big companies that do it. It's just so expensive. Like you look at Exxon, who went in there and drilled, I think, over 10 dry holes that each cost something like $75 million. Like, wow. So oil and gas exploration is expensive offshore. There is lots of technology now that works. But you're starting to see some interest come in to the East Coast again. On the gas side, we're starting to see people leave. Like I say, Exxon spent a lot of money drilling dry holes and is leaving. In Canada, their Deep Panuke asset did produce some decent flow rates for a couple of years, but now they're thinking that play that was supposed to be going on for a very long time is going to be done in 5 or 6 years total. So now what we're seeing here is groups like Statoil. They're starting to take an interest here. Husky Energy is also going in on that same play. So, but at Bay du Nord, but it really is going to be a couple more years before we find out if anything's going to be real about that. But the good news is they are spending money, and if these assets do become commercial, we could see some big oil production off the East Coast as early as 2020.
The Alberta NDP government, are they scaring away investment in the energy sector?
That's a good question. Certainly, on one hand, they've been saying the right things, but then what they've been doing is been given the industry fits. They said that they were going to consult industry a lot, but then, of course, they hired the chief of staff for the energy ministry that was a guy who actively campaigned against pipelines, and so they're also putting in royalty reviews, which actually shouldn't be that big a deal, but also carbon rules. So really, you're just seeing spending in Alberta is grinding to a halt fairly quickly. To a halt would be aggressive, but it's really slowing down. Obviously, it's already slowed down a lot because of lower commodity prices, but now basically everybody is saying, well, we're going to try and maybe move into Saskatchewan or BC or, like I said, offshore East Coast, and just wait to see what happens.
Now, that's not good news for Alberta at all, is it?
No, it's not good news for Alberta. It's horrible news for Alberta. So really the industry here is just, like I said, going to take a complete wait-and-see attitude. And so I sure hope that no matter what they decide, the Alberta government moves quickly and shows their true spots. And I don't know that that's going to be as bad as people think, fairly quickly, so the industry can decide where they're going to put capital.
Well, when it comes to flow of capital, you know how instantly it can be turned off and turned on. Are people going to be moving their head offices out of Alberta? Are they that concerned?
No. That would really that would really be pushing it. I don't see that happening. But you never know. You never know. That would be quite an aggressive step. Like I know when Ed Stelmach was elected premier here a few years ago on the idea that, hey, we need to get more of this resource for Albertans and not so much for industry and profits and investors, but move it out more into the public domain through either taxes, via royalties, or whatever. Investment did stop very, very quickly on that note, and that's back when prices were still pretty high as well. So you're right. Capital can be turned off and on very quickly.
When it comes to leverage, people think debt, but you have a different point of view.
Well, yeah, like right now, like A, all the time, but B, especially right now when prices are low. To me, what I'm looking for leverage, how do I make a lot of money out of a little bit of money? And so one of the ways to do that is to look for companies that have very few shares outstanding. So sadly in Canada, most energy companies have a lot of shares out, like 100 million, 200 million or more. And it's really hard to find companies with only somewhere between 20 and 50 million shares out. So because it's a very capital-intensive industry, you need to be able to raise a lot of money, and you can only do that through debt or equity. And in Canada, we use equity, which means new shares. So it's a very rare management team, Jim, that can buy and sell properties so smartly that they don't have to raise money from the market, and develop things at their own pace. You see the odd company in Canada that can do it and grow organically. You look at what George Fink has done with Bonterra. That has just been a fantastic success story where he's built production up from 0 to 6,000, 7,000, 8,000 barrels a day and spun off huge dividends. The stock's gone from $2 to $60. He's done a fantastic job. You look at other companies like Walter Vrtark's Chinook Energy, where they haven't raised any equity for the last 4 years. Like, that's just amazing. They've done such a good job at building assets, selling them, using that cash to build other assets, selling them. So they haven't raised any money in 4 years, haven't increased the number of shares out at all. And those guys are really, really hard to find. And that's kind of where I'm looking for guys who can do that and grow within cash flow and only have a very small amount of shares out. That's where, like I say, it's like a slingshot. The valuation can change so quickly when you have a big amount of cash flow over a small amount of shares.
I remember you saying that oil could be one of the best investments of the year. Has it turned out to be that way?
Well, yeah, I said what people kind of forget was that back in January, oil was $40. Now it's $60, and so it's like that's a 50% jump. There aren't too many other investments that I've seen that have been up 50%. Now, sadly, the stocks haven't quite done that, though actually, surprisingly, a lot of stocks have done that. They were up from bottom to top 50% between December, January, and April, May. So the industry had a huge run, and now it's kind of settled in here with oil at $60, and these stocks are drifting. But oil actually hasn't been a bad place to be at all so far this year.
Keith, anything else you wanted to add just before we go out and celebrate Canada Day?
Jim, just wish everybody a happy day, safe day, and we'll talk to everybody in 2 weeks.
Thanks a lot for chatting with us.
Cheers, Jim. Cheers, bud.
My guest has been Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin, the website oilandgas-investments.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Check out our YouTube channel, Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. Happy Canada Day. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.